Where is that extra money going, and where should it be going? Let's talk to financial strategist Clark Hodges live on the Kogo News Live line. Hi there, Clark. Where is that money going?
Good morning. I think it's going to retail, consumer cyclicals. You've got restaurants that are going to benefit from it, movie theaters, travel industry, all those sorts of things, and let alone Christmas sales I think are going to be up. But keep in mind the majority of growth in Christmas sales is online. So you may not see the stores being more full, but I do think you're going to have a really good Christmas.
So what about paying off? A lot of people are saying, hey, you know what? With all this extra money, I might pay off some debt. Are we paying off that debt, or are we just keeping this money for some kind of rainy day?
I think by and large, most American consumers will spend the money on something else as opposed to doing the wise thing, which is paying off debt and or maybe investing that money, buying a mutual fund or something along those lines. I think the majority of us say, hey, there's an extra $50 a month, like you mentioned. What can we do with it? Makes you in a good mood, makes you feel like you have got more net worth than you do, and you may, do an impulse buy or something like that. So I think by and large, the American consumer will spend that money.
Now, it seems like it's a kind of a no-brainer to invest it, but really when it comes down to it, you've got that extra $50 a month. Can you start a fund, a mutual fund with $50?
Well, the initial purchase may need to be more than $50, but you can dollar cost average monthly that $50 into that fund, and you'd be amazed at the amount of money someone can accumulate just doing that over time. Of course, it doesn't happen overnight, but most people, $50 a month isn't going to make or break them. And if you can do that on a monthly basis for years and years and years, you're basically setting yourself up to benefit from the growth of our economy. If you're buying American companies and you're buying, movie theater chains, or you're buying computer businesses, or whatever you're buying in your mutual fund, those businesses, as they do better, as they make more money over 5 and 10 years, you're going to make more money because the value of those businesses is going to go up. And so when you have the attitude of an owner, perspective of I own these businesses, I own part of these businesses, and as they do well, I do well, I think you can easily say that $50 a month is something you can do, and maybe even more, but it does make a big difference over time. I'm in that investment business, and I can give you story after story after story where dollar cost averaging, people look up and say, wow, I didn't realize I had that much money.
Well, explain what dollar cost averaging is.
Dollar cost averaging is basically setting up with your mutual fund company an automatic draft from your checking account on a monthly basis on the same day. You choose the day, and you're taking a set amount of money and you're buying that fund. And given the fluctuation in the market, when the mutual fund is lower in price, you're buying more shares, which is a good thing. And when the mutual fund is higher in price, you're buying less shares, and you're accumulating these shares monthly. And so when you accumulate the amount of, you take the $50 and add that up, that money goes in there. But then you get the growth, and you get the growth on more money every month. And so that typically is a great way for the small average investor to get going, to get started, and it really does make a difference in your net worth over a long term period.
All right, that's Clark Hodges, who is a financial strategist, joining us on the Kogo News Live line. Always good to talk to you, Clark.